Okay, let's get started. Welcome to this TradeStation webinar. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. Today, we're going to be doing lesson 6 of this 6-part series on futures spreads and futures options. We decided to create a collection of videos that are dedicated to our FuturesPlus platform. So yes, this is the last lesson. And if you're looking for lessons 1 through 5, which I believe the 3 first ones are on futures options, the first 3 ones are on future spreads, and then we do the last 3 on futures options. If anybody's looking for any prior lessons, let me just go ahead and show you where they are. I need to pull up my browser, so give me just a moment. I think I was looking for different information. So here's Microsoft Edge, and I'm on TradeStation.com. And if you're looking for lessons 1 through 5, they're going to be right here under the Learn menu. And you have to click on Futures Education. On the Futures Education Center, scroll down. We have a collection of educational videos here that you're welcome to explore, including Futures Options Replay, which we did yesterday. But here in this section is where the FuturesPlus Masterclass lessons are. So here's lesson 1, 2, 3, and you use the carousel here to access 4, 5, and today we're going to be doing 6 and completing this series that we call the FuturesPlus Masterclass. So if you're interested in reviewing the content again, just make sure that you know where to go. I'm going to share this link with everyone here so that it's in the chat and you're able just to bookmark it if you want to come back to it one more time. All right, let me go back here to my PowerPoint. Just keep in mind that every symbol and idea that we talk about is for educational purposes only, that these are not recommendations of TradeStation. Also, active trading is not suitable for everyone. And any example that we provide here is just that, an example just to support our educational concepts, and is not a recommendation of TradeStation. As you can see, I'm joined by my friend, Brandon Wendell. He is not affiliated with TradeStation, but we have the privilege of having him here today. He's a trading mentor and an educator, and brings a lot of experience trading futures options, and all of the above. So Brandon, thank you for taking time and being here with us. One thing that I wanted to point out before I give it to you, Brandon, is we are running an in-person masterclass on September 24th of this year. It's going to be an in-person event in Chicago, Illinois, and we have a lineup of professional traders that trade derivatives, and we just wanted to extend the invitation to everyone that's here. I am going to be sharing the link to the masterclass right here in the chat, and I'm also going to be offering a coupon code that provides you a $100 discount towards the registration fee. I'm going to be standing by in the background to answer any questions you guys have on the masterclass, but I'm going to be sharing those links in just a moment, okay? All right, let me go and stop the share and mute my microphone. Brandon, are you good? Okay, there, I see you. How you doing today?
I'm doing great. Thank you for having me back. I appreciate it.
It's our pleasure. So it's all yours, Brandon. Go ahead and take it over.
Awesome. All right. Thank you. Welcome, everyone. Welcome back. My name is Brandon Wendell. As Jesus introduced me, I got the screen share, so you guys should see that. This is lesson number 6. We're talking about practical application now. We went through most of the lessons already. I apologize. My camera keeps cutting out for some reason, but that's okay. The important stuff's on the screen there. And again, this is the Futures Masterclass, Future Series, where we talk about future spreads and options on futures. So when we talk about future spreads, we're not discussing options at all. Actually, future spreads are simply trading one futures contract against another. Jesus showed you in the Futures Education Center and also in the masterclass under Learn, you can actually review the previous lessons and get more basic information about what we're going to be discussing today. Anyway, so today's practical application, as I said, based on what we've already learned. And just a quick background for me, if you're not familiar, I'm a charter market technician, which means basically I went and did a lot of education. It's like a master's degree in technical analysis. And I use a lot of that in my education that I do. I'm a trader full-time, and I'm also a trading mentor. And I've been an expert on CNBC for technical analysis, Bloomberg TV, Fox Business, all of those. I actually have taught courses, technical analysis training courses for those channels, as well as mentored asset managers and individuals like ourselves who just want to get better at trading. I also love to learn about trading, so I actually enjoy teaching because it teaches me just as much as it does my mentees, if you will. I started off in the business as a retail broker, hated it, went into back office operations where I was a trader for the brokerage, getting order flow fills, and dealing with institutional trading as well as retail trading. So I've got a lot of background experience in the markets and how they actually work. So anyway, that's enough about me. We're here about you and about the markets. So we're going to discuss that today. Our agenda is talking a little bit about some of the resources available to you in the FuturesPlus platform. So that way, again, if you're trading options on futures or futures spreads, you must trade on the FuturesPlus platform, which is free. And there's also a mobile version as well. So you get great access to it and wherever you are, basically, as long as you have internet connectivity. So we'll talk about some of the resources TradeStation has for that to help you out. You can do analysis of options on futures and futures spreads. I'm sorry, take that back. Only options on futures in the TradeStation Option Station Pro. So you cannot trade there, however. It will refer you to the FuturesPlus platform if you try to place a trade or an order. So anyway, we'll talk about some of the resources here and what's available, where it can be found. We'll talk about trading the futures spreads, as I mentioned, and we'll spend some time on how it's actually done in practical application, show you examples. Again, it's not recommendations. We're just going to look at the markets as a general educational standpoint, and I'm not going to pick anything that's an actual trade that I want to do. I'm just going to show you the mechanics of it and how you would do a possible trade or look at past trades that have been completed. Again, I'm not doing if you want to get more information on individual trades, join us in the futures options replay, and we'll talk more about individual trades and how they break down there, but you'll get a little bit of a taste of it today as well. And we'll talk about intra versus intermarket spread trading and how that actually applies, and then options on futures and some of the margins as well that you need to be aware of and how to actually find the amount of margin required for the positions you want to take when it comes to options on futures, because the margins are going to be slightly different than what they are when it comes to trading individual futures contracts or even options on equities. So the margin is done with what's called span margin, and we'll talk more about that. So basically in FuturesPlus, there is a tab, as Jesus already mentioned, in TradeStation.com under Learn. So let me see if I can bring over my my screen there. And again, going into Learn, you have Masterclass where you'll find this information, events for upcoming webinars such as this, new to trading, learn using TradeStation, all that good stuff. So plenty of resources there. And my computer's acting a little funky this morning. What's going on here? There we go. So like I said, under Learn tab, you'll find an introduction to FuturesPlus if you're not familiar with the platform itself, and that gives you more information. Jesus put together a whole series of videos to help you with identifying the trade or how to put in opportunities in FuturesPlus and how to navigate the platform as well. So there is more training material. Like I said, there's plenty of courses there on FuturesPlus, all available there. There's quick tips on how to manage different pieces, trading future spreads, trading options and spreads, and all that good stuff. Now, when it comes to trading the futures spreads themselves, we have two different types. We have what are called intramarket. And again, this is going quickly over the basics because we covered that in more detail in individual courses before, I think lesson 1 and 2. And intramarket means the same underlying security. So it'd be the NASDAQ versus NASDAQ or the crude oil versus crude oil futures. A bull spread is when you buy the front month because you're expecting that front month to move up in price faster than the back month. And you sell the back month where you will likely take a loss on that position, but the front month should make more profit than what you're losing on the back month. Therefore, you overall make a profit in the position, in the spread. Obviously, can go against you. There's always risk. And basically, this is what's called the spread widening, where the price difference between the two contracts gets greater and they expand the width. So we're trying to profit from a move upward in the overall security because the front month has the most volume and usually moves the fastest. Obviously, the trade loses money if the back month moves faster than the front. And the profits are going to be much, much smaller than if you simply bought the underlying security by itself. You're taking a loss on one position while gaining on another. If you'd simply take the one position, it would have made more. So why the heck would we even want to do this? The margins are lower for one, so you don't need as much capital. It's not as capital intensive when you're trading. And if the markets move against you, because the rewards are smaller, the risk is also typically smaller. In comparison, there's still risk, and it can be quite great, even compared to the amount of margin you're putting down, but related to a directional trade, it will be smaller. Okay, because again, you've got a short position that's covering the long position if they both go against you. So the rewards, again, it profits when the prices move faster in the front month than they do in the back. The rate of return could also be higher because of lower margin requirements. Not always, but it could be. The bear spread would be the opposite, where you're selling the front month and buying the back month at the exact same time. Again, you're just trying to profit from the prices moving downwards because the front month with the higher volume will typically move faster than the rear month. And we can actually see this in a live market environment if we were to go out to, let's see, oh, where's my TradeStation? There it is. If I just go out to the CME website, or I'll just go here first. So I'll go to markets and we'll simply look at natural gas. So here we are, nat gas futures, and I'll go to E-mini nat gas futures and just get a quote. Oh, that's not it. I wanted NG. There we go. Whoa. Okay. Quotes. Trying to keep it simple. And there you go. On the quote, you can see that nat gas is moving to the downside this morning. Let me shrink this down a little bit. There we go. Let's see more contracts. And we see the front month is the one with the most volume. Okay, it's not always the one that expires next. Keep that in mind. It's the one with the most volume. That's considered the front month. So right here, that September contract is down for almost 4.5%. Meanwhile, the back months, October, November, December, are also negative, but not nearly as much. So if you had placed a bear spread today, you would have been selling the September contract and buying one of these back months, maybe November or October, whatever it may be. And you could see that your short would be making more money than your long would be losing because the price moved further on that back front month than it did on the back, plain and simple. And that's how you make a profit in a bear intra-market spread. In this case, it moved about 29 ticks faster. You see we're at 0.132 to the downside, 0.103. So that's 29 ticks or $290. Okay. And I can even see that if I go, let's see, to a chart, and we can create a spread chart here as well. So I can create a new instrument. We'll go NG. There we are. And I can go to nat gas spreads. Let's see here. We'll hit enter to see all the results. And we can do the, let's see, what were we looking at? September. And we can do September or whatever else back month. So right here, I've got September versus June. I don't know if I want to go that far. That's the only Septembers that I seem to have. So I'll do that. September, June calendar spread. And this is on a 4-hour chart. And you can see right now, this is charting the price difference between the September contract and the June 2026 contract. And as I mentioned, it is going down. The spread is narrowing in this. I'm sorry, no, it's widening in this case. It's getting bigger to the downside. So if you put on a bear spread, you basically, whatever you're charting first, that's the action you're going to take. So in this case, if we pull this back a little bit and say, okay, I think that this was going to be good for a bear spread today, I would sell the front month. In this case, let me zoom in. I think it's, there we go. You can see that I've got this. Oh, there we go. Why is it not locking? Anyway, you can see it says September 25, June 26. Since I'm charting the September 25, that's the one I'm buying or selling. So if the chart's moving down or expected to move down, I would sell that front month and buy the back month. And there it goes. And I can put on that spread in multiple ways in my trading in this platform. So bear spreads, we're expecting the moves to go down. Again, it makes money if it works, where the front month moves down faster. It loses if it goes the opposite way, where the back month moves faster than the front month. But the profits, if in profit, will be smaller than if you simply sold one contract. However, the risk will be smaller as well. Okay. And of course, the margins are much lower, which is why we do this. Now, ways that we can do this spread trading, the reason why we might pick these trades is that markets are seasonal. Now, first of all, one of the big positives that I said for doing this type of trade is that the margins are going to be lower and the risk may be lower. So let me go and change my screen here. First, I'll save this one. And then let's see, we can go ahead and open up. Oh, that's not it. new workspace. Let me see, open recent. There we go. Future Spread Trader. Because I was in my options workspace. And you can create different workspaces, which is pretty cool as well. Again, if you're not familiar with the platform, there's all those videos that Jesus put together for you. So right here, I have a lot of different tools. My charts are right here. It's not loaded up yet. I've got contracts as my open positions, and I can create a spread. So let's say we're looking for an intra-market spread. I'll just call it, let's do NASDAQ NQ calendar. Okay. And leg one. I can actually do this a little bit simpler, but I'm going to go ahead and create it individually right now because I have it. So we'll do NQ. Is that going? What happened here? There we go. CME, future, NQ. And let's say we're going to do September. So I'll select that for the first contract. And then the leg two, back contract, again, explore, NQ. And let's do December. There we go. And that looks good. Apply. So it should be saved, and close that out. And let's see if I scroll up. These are all expired ones. That's the ES that somebody else did. Where is mine? I think it might have created the chart here. Let me just check that. No, that's the Russell versus NASDAQ. That's an intermarket spread that I did. But again, I can create the charts for it. I was just trying to find on the auto spread, or maybe I didn't save it properly. And let's see, owner. If I didn't, that's fine. I can go ahead and find a new one or create a new one. Oh, there it is, NQ calendar. There we go. And I can go ahead and open chart. I can even open a chart with the individual legs as well if I choose to, which is cool. So you can actually chart individually. Now, it did a 1 minute chart, which is going to be absolutely useless for me. So I'm going to go to a daily chart. And it may look a little funky because of the way that this is created. Typically, intra-market spreads, and it's loading right now. You see the little wheel going here. Intramarket spreads, I normally will view some of them as a line chart rather than candle, because you'll just get a very wiki type of situation there. Now, why would I do this? Again, I could do an intramarket spread if I think the NASDAQ is going to continue to be bullish for a while, but I don't want to take on the overnight margin of one full contract. And I also may not want to take on the full risk of one full contract by going long. So instead, I create a bull spread. I would buy the September contract, the front month, and sell a back month contract, whatever one I choose. Typically, I wanted to have some volume, so I may go with an intra-market where I'm using the next contract rather than going out too far. And again, you just got to be careful because of the volume. So for instance, if I go to markets, I'm on the NASDAQ again. I go to quotes when I get there. We have E-mini NASDAQ futures and quotes. And you can see the front month has 273,000 contracts traded so far today. The next contract, 533 contracts. And beyond that, it's very thin. So I would not get great pricing. Now, had we bought this today, it looks as though we are up 195 points on the September contract. We're only up 193 points. So there would have been a 2-point widening of the spread, meaning if we had bought September, we would have made an extra 2 points compared to what we lost on the short for December. And the 2 points, would that be worth $40? It's the same point value, it's $20 per point. And that's an intramarket spread. Pretty simple, right? Now, another reason why you may want to do this is nearly every single security goes through seasons. Now, they're not tied to the physical calendar. It's not like spring is always March, okay? It could be a completely different month. As a matter of fact, gold, for instance, spring for gold is August right now. We're starting spring. That's the beginning of a bullish trend. So gold typically becomes bullish in mid to late August. Summer is where we're in a very strong bullish trend. Again, for gold, that would be September, October, all the way through till about February. And the reason why is spring is for gold. Again, every security has a different season, and there's places you can go, websites that will sell you information on seasonality. Unfortunately, it's not free. You might be able to find some free information, but most of the time it's behind a paywall. But this is something I follow on a regular basis. I do spread trading on futures every single day. I may not enter the trades, but I monitor them, and I do that for my students as well. So I keep an eye out and I do these trades. Anyway, my point is the reason why spring is in August is because that's when the European jewelry manufacturers start ordering gold for their building of jewelry, creation of jewelry. In September, October, you have in India a holiday called Diwali. And Diwali, you're supposed to put out gold coins as tribute to Lashmi, the goddess. So you have a fortuitous new year. And it's also the Indian wedding season. So demand for gold is very strong during Diwali and that wedding season. You got the end of the monsoons and beginning of all the good season. Then you go into Christmas and gift giving. You've got all the way through good demand, even through Valentine's Day, and the Chinese New Year is the end of summer for gold. That's the highest demand. Again, gold coins. Then we go into autumn where things start to turn to the downside. There's not as much demand because after Chinese New Year, there's no big holidays for gift giving of gold. And then autumn is the beginning of the fall. Winter is a full-blown bear market where things are usually moving down. Again, for gold, that would be the early summer, June, July. And then again, in August, the cycle repeats over and over again. Now, these cycles can be interrupted due to socioeconomic events. So they don't always follow through, but the majority of them do. And spread trading, I mentioned this before when I talked about it in the lesson, it's a big thing. This is not something that a few niche brokers do. This is a huge thing for the brokerage industry and also for producers and users. If you think about it, a company like Starbucks, they might be worried about the price of coffee beans fluctuating during seasons, or if there's a huge fire, or if there's a big torrential monsoon and the crop is affected. They use these spreads to help hedge their actual positions in the physical commodities. So that's why this becomes very popular. And it's anywhere from 15% all the way up to 50% of the volume of futures trading, depending on the commodity. So this is pretty big. And because it's so widely followed by the professionals, it may be something you want to take a look at, because if the big professionals that are throwing millions and millions of dollars at it are following this and having success with it, why shouldn't you? It makes sense. So seasonality is usually with the commodities, it's based on long-term patterns. It's not just 1 month or 1 year of observations. This is at least 10 years of observations in the average price movement. And we have it in the stock market. You've heard of sell in May and go away. And we're coming out of that summer slump for the equity markets typically. You've heard of the Santa Claus rally, right? That's a seasonal move in the equity markets based on sales, Christmas sales, right? So there are seasonal moves in almost everything out there. And if you learn those seasonal moves, it gives you a higher probability of predicting the potential trend direction for your securities. And it's something that we trade heavily when it comes to spreads. So intermarket spread trading, that's a little different. That is trading one security against another related security. They have to be related. You can't just pick random securities. So for instance, we would use technical analysis, and I actually do use Bollinger Bands quite a bit with this because it helps me identify the trend as well as overbought and oversold situations. The other indicator you'll see on the bottom that I use is the RSI. And I use both of these on a regular basis for spread trading. So again, if I go back to, is it this one? No, here. And go to my spread trader. Why is that not loading up? Let me try 4 hours. And actually we'll switch we'll switch charts here. I'm gonna get rid of this chart. And I'll go back to an intermarket spread that I already have charted here. This one is a 4-hour chart on the Russell versus the NASDAQ. Now, you have to keep in mind that they're not necessarily equal. What do I mean by that? When we trade these, right now I have the NASDAQ showing here. I'm going to go to margins. And when it comes to trading spreads, you want to be close to delta neutral, because some securities are more volatile than others, and they have different point values. So one may move faster than the other. And in the case of the NASDAQ, right now, I'm looking at what's called the outright volatility scan. This is showing me the maintenance margin for just buying the NASDAQ future, long or short. And of course, I can also go other places for this as well, especially on TradeStation. If you're trading the individual, going to TradeStation.com, under pricing, you'll see futures margin rates. And I'll see the overnight margins, both the initial and the maintenance margin. So it's a little bit better than the CME website, honestly. The reason why is here you get the details. So for instance, on the NASDAQ, there it is, intraday initial margin, intraday maintenance, long overnight margin, and short overnight margin. I get both of those. So you can see that holding this overnight long has a little more risk, 33,000 versus short 32,000, and the maintenance margins are different as well. Unfortunately, in the CME website, they only show you the maintenance margins. I don't know why, but that's what they do. Now, intramarket, that's going to show me the margins for trading one versus the other. So here, for instance, if I go long on September, short December, my maintenance margin is only $323. If you want to calculate the initial margin to get in, it's very simple. You just multiply by 1.1. So 323 times 1.1, the initial margin is 355.30. So we went from $30,000 overnight margin to buy a NASDAQ futures contract to only $350 to do an intra-market spread, full spread. Crazy, isn't it? And what does that mean? Because your margin is so much lower, your rewards will be much lower. Today, it was only profiting 40 bucks. But hey, 40 bucks divided by 355.30, that's an 11.2, we'll call it 11.3% rate of return. So that's a pretty good rate of return. Now, again, if we had traded the individual NASDAQ future, the market moved up, I think it was what, 150 points or something, times 20, you would have made $3,000. But remember, it was $33,000 for the margin. So you only had a 9% rate of return. So which had a better rate of return? The spread. Even though you only made 40 bucks, you only used 355 to get in the position. So you had 11.3% return. Meanwhile, here, you only had 9% return, 9.1 on your directional trade. Of course, the dollars are going to be huge, but then again, we had to spend $33,000 versus, and even if we did the intraday margin, it still would have been decent rate of return in comparison. Now, this is, I go here to intermarket spreads and notice something here. There's a new column that shows up called ratio. I mentioned that typically when we do option spreads, we may want to be delta neutral if we're trying to do a trade where we're trading time or volatility rather than direction, right? We go delta neutral, we isolate the delta so that way we can make profits on time or volatility, vega or theta. Same thing here. We want to go somewhat delta neutral when it comes to a spread so that way we're not biased on one security or the other. And you'll notice ES versus NASDAQ is actually a 3-to-2 ratio. I was looking at the Russell and you saw the Russell, I actually had a 3-to-1 ratio. So I got to keep going until I find that Russell. There it is, NQRTY. And actually, based on the volatility, it's changed since I last looked. The margins are also a bit different. We're going to have to trade 5 contracts. We're going to have to trade 1 NASDAQ contract versus 4 Russell contracts. So I just make the adjustment in my charts. That's all. So right now I've got a 3 times. Just go up here and I can change it 4 times RTY. And I'm just using the continuous contract NQ. Let's see if that works. Expired contract. Okay, maybe I have to do the specific. Shouldn't be expired. I thought I did continuous. There it goes. Nope, did it. Unfortunately, I changed it to a 4-minute candle. Let me just go to maybe 60-minute. And did not change. Oh, it changed it to 4-minute. Okay, I have to change it differently. Actually, what I can do is this instead. Again, I go to my auto spreader here and create it that way. So create NQ RTY enter. Leg 1, explore, future, NQ. Actually, I could do it the other way around with the Russell first if I want to. Doesn't really matter, but that's fine. I'll do Russell since I'm doing 4 of those. And I'll find the RTY. There we are. And we'll do September. Ratio 4. Next leg. Oops. Explore. Went to O, and I'm going to scroll up to get to NQ. There it is. September. Select. And we're doing -1. Now, the multiplier, that's important as well because we have to do notional values, not the actual price. Remember, whenever you look at a security, there's 2 prices. You have the market price, which is what's on the chart, and you have the notional value, which is the actual value of the security. To get the notional value, you multiply by the point value. So the Russell is 50 for the multiplier, and we're going to do -20 for the NASDAQ. There you go. And you can put in tick info if you want to. I'm not going to bother, but that's it. That's created that spread. It's called NQRTY enter. I can actually share this for everyone on TradeStation. and save it. And there it is, NQRTY, enter, shared. Local means I'm the only one who sees it. Shared means everybody can see it. And if I click here, I can go, let's do open MD trader. No, sorry. Open chart with legs in tabs. Perfect. So now I'm creating this chart. It actually did a 1 minute chart, but I can change that obviously. And let's do that. We'll change it to 240. And it might take a few moments to load. You see it's doing it. And if I want to, I have a chart of the Russell itself and a chart of the NASDAQ itself. And then I have the spread, which is for NASDAQ contract, for Russell minus that one NASDAQ. And I can trade that. Now notice this is currently heading down, which means I would sell whichever contract was listed first. I labeled it wrong. Remember, I put the Russell first and the NASDAQ second. So I'd actually be selling the Russell 4 contracts and I'd be buying the NASDAQ. And that's it. That's a spread trade. As I said before, I typically will use certain tools. So I can go ahead and bring in technical indicators. I like using RSI for momentum. That's one. And I don't use the typical, they show 80-20, but I use 60-40 for overbought, oversold. You can change the colors and the lines as well if you want to. And I'm just going to create that. There we go. So there's my RSI at the bottom, showing me that we actually have bearish momentum right now. And hang on, let me fix this font size. That's a little bit better. I also can add in the Bollinger Bands I was mentioning. So I could do this type of trade, again, based on seasonality, because there's seasonality on spread trades, intermarket, as well as intra. And I'm just going to leave this the way it is, I think, for now. I can change the colors later. So we are in a bearish trend because we're failing to reach the upper band, basically bouncing off the mid band, and we have bearish momentum to the downside right now. So I would be selling this when we reach an area of supply, which we're not at right now. We already came off of one right here. We're close to it. So it may not end up hitting it, but that's how I would set up a possible spread trade and make sure that it's the right ratio for the delta neutrality. Otherwise, you're going to have a bias on one security or the other, and you may not want that. So unfortunately, it didn't quite hit the supply for the entry. It hit the midpoint of the Bollinger Bands, which also can be a trigger with bearish pressure telling us we need to sell off. And we're having some struggles getting through this area of demand right now, although there is enough momentum that we may be able to do it on the next test. So I trade the spreads on technical analysis pretty much the same way I trade individual securities, just looking where the institutions are buying and selling and piggybacking off their decisions. And I use the institutional information on seasonality to increase my odds for success. There we go. And that's it. And we can do that, as I said, on intermarket or intramarket. And there's several different sources out there for the seasonality information, as I mentioned before. A couple of them I use MRCI. Unfortunately, you have to pay for them, so I'm not suggesting you want to go out and do this, but you can if you're interested. Let's see, there's my password if you want to use my account. But just to show you as an example, for instance, spread seasonal patterns, I can go out and see what is the normal pattern for, let's go to interest rates and do that. We'll do the knob trade, notes over bonds. It's called knob. So here we have 10-year notes versus 30-year bonds. And let's say we're dealing with the upcoming December contract. This will now show me the seasonal patterns. And I can go, let's see, we'll do first. I can even put in Bollinger Bands and some other stuff there too. But right here, we're now looking at the seasonal pattern for the notes over bonds trades. And it looks as though we're getting into a potentially bearish time for the 30-year bonds. Okay, seasonally for the last 5 years, from mid-September into mid-October, the bonds failed against the notes. That means that you would sell the bonds, buy the notes. Let's see if that's historically backing it up. Last 15 years, it actually goes mid-August, a little bit earlier. Last 30-year pattern, oops, I'm going to get rid of the others. Now, is that going to be guaranteed it'll happen this year? Of course not. Of course not. But late August into mid-October, as you can see, historically, there is a decline in the bonds versus notes. So you could buy the notes over bond spread. We would do that by going back to, whoops, wrong one, TradeStation FuturesPlus, create, knob, contract number 1, explore, CME. I'm not putting this on now, of course. And we got to find the 10-year. which it is sometimes ZN, but I think here on TradeStation and in the CME, they use there it is. They use the electron or the pit symbols. And it's not showing me the one I want. It's showing me the 10-year September. That's okay. I'll do that one for right now. Select. And then we go to 30-year. Let's see if we can find that one. Oops. 2, 3, 30-year. September. I'm sure I could find it if I dig a little deeper for the other ones. I also want to verify that I've got the right ratio of 1-to-1. I may not. So I'm going to have to go back to the CME group. It may not be the easiest thing to do to figure all these out, but I'll just go to 10-year note, margins, and take a look to see what the ratio is supposed to be. Enter, and I got to find the 30-year. Let's do a control search 30, and that's not it. So let's see, next page. Where's the 30-year? Not there. I'm gonna have to search for a little bit. And there's actually another place I can also go for this to get some of the margin information, which I'll show you as well. Nope, nothing there either. Maybe I'll go to 30 years and look for the 10. Oh, there we go. 10-year note futures, 30-year yields 6-to-1. I'm not sure if that's the right one though. Yeah, I think it is. Actually, I may not have the right 10-year on that one, but 6-to-1, that's crazy. And it's 6 30 years versus 1 10 years. So I could actually go ahead and weigh that properly to get the right chart if I want to. So in this case, the ratio would be -6. And the multiplier for notional value, each one of these is a point value of 1,000. So if I want to actually put it correctly, I put in the multiplier for the point value, save it, and there it is, knob. So again, I can go ahead and look at open chart, or if I want to trade it, I can open up MD Trader. And there's my matrix. And for some reason, I'm just not getting the data here. I'm not going to worry about it right now. But that's what I can do to find some seasonal trades. As I said, there is trade information as well. A lot of these services also provide you with some ideas. Be careful. I don't blindly take any of the ideas they put out. Okay, I always do my own independent research to make sure that they're right. If I go, I'm not going to show you current ones, but I'll go to previous trades. And in previous trades, they have trade calendar information, seasonal spreads. So if I were to click on that, you can see that there were some seasonal trades that they put out. Let's say, and by the way, a lot of these have very high probabilities. Notice the first one, buy December corn, sell September corn. That's a seasonal move. And this is the pattern. Okay, they were selling that in June or July, and you can see it dove. That's a normal seasonal pattern. Selling June 1st, getting out August 13th, 100% winners over the last 15 years. And I'm telling you, you got to be careful. Here's why. If I click on it and go into the detail, it may have always been a winner at the end, but sometimes you have a big drawdown. This one doesn't have too big of drawdowns. It's lucky, but I've seen $10,000 drawdowns before, this one, it made $225 drawdown before it was profitable by 125 bucks. Yeah, it's not necessarily great. Some of them didn't draw down at all. This one looks like a pretty good overall trade. They even tell you sometimes, though, here's the thing. The average profit on winning trades is only $650. In order to make that average, you had to have a stop loss of 850 bucks. That's not necessarily a good thing, right? The reward risk ratio is skewed the wrong way. So just be careful. But there are some really great spread trades you can use. I look for moves where perhaps we close above the band and closing back in the band and seeing some sort of divergence to let me know trend is changing and take the trade. So I often will just chart these and trade off my technical analysis the way I would with any other security. And that's what works best for me. So seasonal spread trading, again, you can enter on the approximate date of entry, and I look for seasonal entries based on it hitting a technical level. And if you want to, you can place your stop at 1/3 the average profit or your maximum amount that you are willing to lose. And that way you have a good reward risk ratio. And then you can exit on the approximate date or if you hit an area of supply or demand. And that's a good way of trading it. But again, do not blindly trade it, chart it to make sure it's a good opportunity that you want to take. And be aware that even if you place a stop loss, because some of these trades are on securities that have lower volume, they're further out, you could experience higher slippage, meaning by the time you actually exit the position, your loss is greater than you expected. And the nice thing about spread trades, especially seasonality trades, is there's a high probability they're going to follow through. The bad part is, again, that volume is not very high on some of those contracts. We saw the NASDAQ contract, December only had 250 contracts traded today. So the chance of getting out quickly, it may not be there. You might have to take a much worse price to get out. As I said, seasonal patterns are there for inter and intra-market trading, and it's something I do on a regular basis, as you see. So in this case, again, you just have to make the adjustments. I actually use a different platform for this one, seasonalgo.com, and you can chart them, and you have to make sure you do the notional values and you adjust the number of contracts for the delta, the ratio. So as I said before, you can also use other tools. This is the spread matrix, which is great for intramarket spreads. And then I can create that auto spread trader to find intermarket spreads. So I was saying on the intra, if I open up a widget, it's a market grid, yeah, auto spreader right there. I can do, we got NASDAQ versus ES if we wanted to, or there's the Russell versus the NASDAQ, or let's say we want to do corn versus soy. There we go. Let's select that. And I think it's still loading, hopefully. And it should show me pricings for that spread trade. It's actually not what I was looking for. So let me close that. And spread matrix, that's what I was looking for right there. So again, I can go ahead and do an intramarket spread by looking at, let's do crude oil spreads. And there we go. There's my intramarket spreads on crude oil. I have September crude oil versus October, November, December, all the way out next year. And I can trade these spreads by clicking on any one of these. It'll bring up my order box for my spreads. It's pretty cool. So when it comes to options on futures, now we're shifting gears here a little bit in our last little section. When it comes to the options, I've already talked about the basics again in the options course that we did, the earlier lesson. I think it was lesson 4, maybe 3 or 4, I don't recall. But again, if you're not sure, look it up. TradeStation.com, learn masterclass. And if I scroll down, there it is, future spreads and options, key futures options mechanics right there, capital optimization. It was lesson 3. So you can watch it. And then there is option spreads on lesson 4. So there you go. We got plenty of information for it. You can watch those whenever you want. So getting back to this again, you're just trading options on futures versus options on stocks. There are some definite differences as well. And we can do multi-leg option strategies. The nice thing is, if you're not familiar with all the types of spreads that you can trade, thank you, David, under the Options Education Center, yes, we have a futures education center at TradeStation, or I should say they do. I'm not a TradeStation employee, but there's also an options education center, which teaches you a lot about the different strategies. Those strategies can be transferred into trading options on futures. For example, if I go back again under Learn, Options Education, and they're adding more content every day and organizing things. Here, if I want to learn how to do a ratio back spread, this ratio back spread info that's there can also be used on options on futures. And again, it's got the information on the strategy. There's a video, there's an article there, and there's even workspaces on TradeStation to help you, which is pretty cool. And again, there's a link for it, and we'll post all the links later as well. But basically, multi-leg option strategies, the reason why they're done is to neutralize some of the Greeks. The Greeks are the risk parameters for your options. I mentioned before that we can do ratios to neutralize the delta. So that way we have a neutral delta and we're trading other things. For example, if I go back now, oops, I just had it, darn it. Under my trading page, open recent, and we'll go to futures options trader where I was. And it doesn't take too long. I'm surprised it's moving quite as fast as it is. I got a lot of things open. I've got 5 computers running right now. Kudos to Verizon. Anyway, you can see that when I look at these options, I don't have all the Greeks up there. I have Delta, but I can add the Greeks in this matrix if I want to. I happen to be looking at the Swiss franc right there. And I do have positions on the Swiss franc currently. Looks like it's profitable by $200 or so. You can see I've got longs and shorts. I also have platinum and even the NASDAQ right now for different reasons. So anyway, let me go ahead and focus on this for a moment and change the number of options we're looking at to 7. There we go. So these are the September Swiss franc options. And if I go to edit columns, I can bring in, there we go, Vega, Theta, and Gamma. I'm not going to worry about Rho. All right, perfect. And we can zoom in on this, which is cool too. So let's say we'll focus on the put side because that's the easier one to see right now. on the puts, let's say we're looking at the money put right now about 124.5. We have a delta of 51 roughly, because that's at the money, right? So it's going to be about a delta of 50. If I want to neutralize that delta, that way I can focus on the volatility, vega, or time. I need to find another option that will give me negative 50 delta or thereabouts, right? So maybe I buy one option and sell another option. By selling the option, it'll do the opposite delta. Or maybe I don't want to neutralize delta. Maybe I want to make profit on a direction, but I'm worried about time decay. Because I bought this option, I have negative time decay of 24.39 per day. It's going to erode my premiums every single day. So how do I neutralize that? I do the opposite. I buy one and sell another. In this case, I sold this option. And what it did was it reduced my theta, my time decay, from 24 to about 3, the difference between the two. And that's the reason why you do spreads. You are neutralizing some of the Greeks, so that way you still have other Greeks that are helping you out. So in this case, we put this all together. Again, my theta is now 3. Can't draw it very well. The difference between the two. My vega, or volatility exposure, again, difference between the two, 135, 61. We're looking at a little under 30, right? So we'll call it 20, what is it here? 26. So I've reduced my volatility exposure where I had 161 to 26. So I've reduced that volatility. I've reduced my time decay, but I'm also going to reduce my profit because my delta, let's do a delta triangle there for it. My delta is also reduced to about 22, and it's a negative 22, which means I profit if prices drop, but I don't get to profit 50%. I only profit 22% of the underlying move. So I've reduced my reward on the delta by neutralizing the time decay and the volatility decay. But that's why you do spreads. You always do multi-leg options to be able to manage the risk. You don't eliminate it, but you manage it and you change the exposure of your risk by doing a spread. That's why we do it, both for spread trading in futures and option spread trading. And in this case, let's see what positions I have open on the Swissy, for instance. If I go to CHU, you can see I've got I had this written down here. Where is it here? I have a put that's short 126 even put that I'm short, and I have a long put at 124.50. Okay, so that is a bull put spread. I basically sold the 126, and it's losing right now, unfortunately, but hey, that's the way it is. It was definitely profitable for a while. I'll show you where and when. If I zoom out, here we go. This was put on a while ago, and I forgot to get out of it. I went on vacation, just came back. But in early July, late June, I put on this spread because I expected prices to be moving up. So I did a bull put spread and a bull call spread. The bull put spread involves selling a put, buying a lower strike put. Why? Reduces the exposure to time decay and to volatility changes. But it still allowed me to participate if prices move to the upside because the delta would give me profit. That's it. At the same time, you'll see I also did a bull call spread where on the Swissy, I bought the 126 and sold the 127.50. And it's the same reason, because I expected prices to go up. I expected my long call to profit, but I used the short call to reduce my risk based on volatility collapsing and on time decay. Because if volatility went down, long calls lose value, right? They have positive vega. And I have negative theta because my time decay erodes my value. So I did the spread to reduce that risk. That's the only reason why you do them. And it also reduces my margin costs, of course. And when it comes to futures options, there's a couple tools that you can use. I think, do I have it in here? No. I mentioned it too, actually. In our last session, lesson 5, we went over volatility and how to deal with margins when it comes to futures and options on futures. So right here, if I go to my CME login account, or my account login, excuse me, and we're almost done here, so I'll take a look at this question as well. I got to enter this. I got a dual login, protect me, Open Duo Mobile, and I'll look at the question to help you out as well. because yeah, I'm pretty much wrapping up here. So if you have other questions, let me know. Okay, there we go. So when we think about contracts, we also monitor Black-Scholes, sure. Layering options on futures, yeah, absolutely. It does the same thing. Futures do have backwardations versus contango. If we think about how the options price will move relative to the underlying, it get cloudy. Not necessarily. If you're doing a counter spread on the future, you don't have to worry about the Greeks. If you're doing options with counter spreads, then yes, that's going to be coming into effect a little bit. But typically, backwardation has a tendency to try to go back to contango. So you could use that as part of your process. If, for instance, like I said, you're backwardation right now, you've got the back month that's more expensive than the front. I'm sorry, other way around. The front month is more expensive than the back, then that's actually good for a long call on the back month because that should be going up in value, and then selling the front month calls because they should be dropping in value, right? So you could actually use that backwardation as a little bit of a lean to tell you which direction to trade the markets potentially. So do I have a simplified process? That's probably about it. If I'm in backwardation, I may want to lean more on the long call or short put for the longer term because I'm going to expect prices to be going up. So I may want to have a bullish bias on that further out option. And then the shorter term options, I'm going to be leaning more towards them going back to contango, which means the value should be dropping. So I'd either be selling a call or buying a put on the short term. That's probably the simplest way I could do it. Is it guaranteed to do that? No. Crude oil has been in backwardation for years now, hasn't it? But there is a little bit of a lean that you might be able to have because of that. So hopefully that makes sense. I think I answered the question correctly or interpreted it properly. Anyway, under the customer center, this is what I want to show you real quick. We do have a margin calculator, and then we go back to margin calculator. Again, this is in lesson 5, more details on how to use this. But let's say I wanted to do a spread trade on, let's do that NASDAQ one versus NQRTY. Okay, futures and options. Actually, yeah, no, I'll do it this way. First, NQ, and we'll do December. And I'm going to be doing a long on the NASDAQ, and then RTY, December. Remember, I had to do 4, so I'll do -4, save in margin. And it's going to show me what margin I would need for that position. And there it is. Initial risk margin, 22,000. Maintenance margin, 20 grand. That's what it showed me on the website as well earlier. But what you can't get on the website is if I'm doing options. So let's say we want to do a calendar spread on the NASDAQ, since we're talking calendar spreads. Before I do that, cancel. Take off this plus sign. There we go. And new portfolio, enter. And we'll say NQ calendar. And I need to know what kind of margin am I going to need for this calendar spread. We go NQ. And let's say we're going to sell the front month, September. Oh, I did the wrong one. I need options. That's futures. Sorry. So again, NQ. Now, if you don't know what the symbol is, you just start typing it under product name and it'll bring up the symbol for you, which is pretty cool. So here we're going to do period code, front month. Let's say we're going to do calls and strike price. Current at the money, we're probably looking at what, 20, I forget what it was now. Here we go. And by the way, you can also do analysis on this on TradeStation, Option Station Pro. So 23,850 is where we're at. So we'll do 23,500. And we're going to sell that front month. And we're going to buy a back month. Oops, I did that wrong. But that's okay. I can do it this way. NQ. Let's go out to 2026. Come on. And we'll do, let's see. No, actually, we do 2027. Why not? There we go. 12/20/27. If I didn't want that, I could put it in a different month. It's no big deal. Again, we're doing calls for that calendar spread. And I can do a different strike price. I can make it diagonal, or I could do the same strike, which was what, 23.5. And we're going long on that one. Head to preview, save and margin. There we go. And it'll tell me what the margin would be for that calendar spread. It is 15,000, basically, for both those options. It's because of the long term of the other one. So yeah, that's cool about how to do those different types of spreads and options trades and why we do those, as I mentioned. Let's see, where am I here? Oops, did I close out? Yeah, that's about it I got for you guys for today. Hopefully that answered all the questions that we had. I want to thank everybody for having me here. Thank you, Jesus and TradeStation. Again, if you've got more questions about this, email education@tradestation.com. They'll be able to forward your questions to me as well. And you can catch us on the options replay for futures as well as equities for additional information.
For sure. Yes. Thank you so much, Brandon, for that excellent presentation. And as Brandon pointed out, yes, check out our calendar for upcoming events. And also just remember that you can find recordings of these sessions on the TradeStation Futures Education Center. Very easy to find. Just go to tradestation.com, learn futures education, and you find all the content there. All right. Thank you, everyone, for being here. Brandon, again, thank you for your time. And I'll see you guys later. Thank you. See you next time. Bye-bye.